All right. All right. So we just started the recording. All right. If we could take a moment in prayer. Dear Lord, thank you for another moment, another opportunity, another day. Thank you for the blessings you have given us. Thank you for this ministry. Thank you for everyone who has logged on to this call. Bless those who are on the way. Bless those for whatever reason could not be here. Bless everybody's family, their finances, their well-being, their spirits, their hopes, and their dreams. Bless the presenter today. Thank you for her wisdom, her experience, her guidance, all that she's done for us in the past. Thank you for allowing her to be here today. Thank you for her husband, James. Bless their family. Bless everything they're going to give us. Let's learn something today so we can take it out into the world on behalf of your son, Jesus Christ. It's in his name we pray. Amen.
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 I just want to welcome everyone. This is the Personal Finance Ministry at 3rd Street Bethel A&B Church, located in Richmond. And we're continuing our studies, our monthly studies to gain insight and wisdom into our personal, how to manage our personal finances in a godlike and Christian way. And we try to set up speakers to come to talk to us, speakers who have a certain level of expertise in the area that they know. And backed by popular demand, this is about the 5th or 6th year she's done this, I think, is Gwen Carney, or as it says your screen, Gwen Falsh Carney, because I don't want to, I know that there's her family's on the screen, so I want to recognize them. And but she has blessed us with telling it like it is when it comes to our taxes, even if we don't want to hear it. She'll tell it to us like it is. And as many of you know, she's a certified public accountant. She has her own business. She prepares taxes and helps people with their personal finances, and she does that for a living. But she's also a member of 3rd Street. She sings in the choir. Many of you are Deltas. You all know she's a member of Delta Sigma Theta Sorority Incorporated. And okay, I see about flashing signs on them. And I see my fellow AKAs, they're just nodding like, okay, we see you, Carla. Okay, all right.
This is her church.
But thank you, Gwen. And without further ado, we're going to, I think we've thrown the host over to you, Gwen, so you are hosting this event. So.
I just want to ask everyone if they could please mute for the presentation, and then you can unmute afterwards for the discussion.
And put questions in the chat ahead of the discussion if you want Gwen to address that. We'll keep her apprised as to any questions in the chat.
So good afternoon, everyone. It'll be afternoon in a minute, but good afternoon. First of all, thank you, first of all, for coming out and spending the time to get to know a little bit about the tax season for 2023. And not that it's a whole lot different than 22, but there are a few changes that we need to make you aware of. I always have to give a disclaimer first, knowing that there is no one that knows this entire tax code. Absolutely no one, including myself. So therefore, if I can answer a question, I will try my best. But if I cannot answer a question, then I ask that you put it in the chat, and we'll try to see if we can research and find out the answer. In some cases, if it's a personal question about your own taxes, then my suggestion would be to consult your tax preparer, because those who I prepare taxes for know how to consult me. But I will do my best to answer all questions as possible. So before I dive into any tax tips, I thought it might be a good idea to probably refresh your memory on a few changes that were made in 2022 that are still in effect for 2023. So I'm getting ready to share my screen. So I just click on my thing down here that I want first. Click on that. Can everyone see my screen so far? No?
No.
Okay, so let me go back. I have to hit share screen first, right? All right, and then I'm going to pick this and then share. Okay, can everyone wonder what they're up to now? tax tips for preparing 2023 taxes. We're good? Okay. So I have to go up to the screen here to do my slide. That's a slide. Okay, it just hit on it. So let's refresh your memory. What'd you say? Oh, drag this up. Okay. Okay, so do we realize that what happened this year is you're going to have some standard deductions that increase and therefore eliminated numerous taxpayers with the ability to itemize their deductions. Now, I need to speak on this a little bit because you're going to find out later when I take you through a scenario, because sooner or later, I tell you, you're going to need some paper and pencil because I want to take you through a scenario using a single person, and I'm going to take you through a scenario using a married couple to show you what tax difference it would make if you had the ability to itemize your deductions versus having to live with the standard deduction that the IRS had decided you should have. So just know that sooner or later you're gonna need paper and pencil because I'm gonna walk you through two situations for a single person and then a situation for a married couple on the advantage of being able to itemize versus taking the standard deduction. The next thing that happened last year, you may remember that the personal exemption was eliminated. So therefore, I don't care how many folk you have up on that tax return, you're not going to get an exemption for each person on the return. So, you know, your 8 children and you and your husband, y'all not getting those 10 exemptions on your return. They eliminated the ability to use the $4,000 per person and reduce your income. That is no longer the case. What they have done is they increased the standard deduction. The very first thing I spoke on, they increased that in hopes that it's enough to reduce your income by, but in most cases, a lot of cases, it's not. Some people did get an advantage for it, but there are plenty of people who did not. There's a cap. That cap, I'm hoping to goodness that the Governor Youngkin gets into stopping, or not the governor, the federal government. I need to say IRS. The IRS really needs to stop.
Go find your coach.
Huh? The IRS needs to stop. Somebody needs to mute their. Okay, thank you. The IRS needs to eliminate that cap because what's happening is there are persons who itemize right now that their income is at such a level that the 5% for those of us who live in the state of Virginia, the 5% taxes that we're paying to the state out of our paychecks is actually a deduction. It's an itemized deduction. But just imagine that if you made $100,000 and 5,000 of it is taxes for that, and then you've got a real estate that you're paying taxes on, you have vehicles you're paying taxes on, they are capping us at $10,000. So once you have shown that you have $10,000 in deductions, but suppose you had 12,000, you have just lost $2,000 because you can no longer go over the cap of 10,000. So I'm saying the IRS really needs to look at this because this has hurt a lot of people who used to itemize, that you have now limited them, that they can no longer take over $10,000 in the area of taxes when it comes to itemizing. Now, if you do the standard deduction, that's not going to matter. But if you itemize, it does matter. They also eliminated miscellaneous deductions. I had someone ask me the other day, okay, this is what I paid you to do my taxes last year. Can you deduct it? And the answer is no. You cannot deduct the cost of having your taxes prepared. It used to be a deduction at 2%. If it exceeded, it used to be a miscellaneous deduction to show how much you paid to have your taxes prepared. And as long as your miscellaneous deductions exceeded 2% of your adjusted gross income, you could deduct it. Well, it's no longer deductible. Another thing people lost out on. There are people who are doing things for their job. The best example happened when we went into the pandemic. There are a lot of people who end up staying at home, burning your electricity, burning your gas at home, so that you could work for your job. But you couldn't deduct it because that's considered an employee business expense. If you're an employee, you no longer have the ability to deduct job-related expenses from your W-2. But you used to be able to deduct that. Some people have certifications, nurses who pay for different things. They used to pay for union dues. You can no longer deduct such a thing. So this has hurt people, which is why there are folks who can no longer itemize who used to be able to do so. The starting date, of course, for IRS has already started. There are people who have already applied and have gotten back their monies already. Matter of fact, this year, the federal government has been faster in returning money than the state of Virginia. Believe me. But you have until April the 15th, 2024, with extensions granted until October the 15th, 2024. So let me tell you a little something about these extensions, because people see the mistake we make is that we assume that because we can extend preparing our taxes until October does not extend your requirement to pay the government. So that means that if you have any slight notion that you think you may owe the government at the end of the day, they must have it. That's the purpose of the extension. The extension is saying to the IRS, hey, I don't have time to do your paperwork right now, but here's your money. So we have people who file extensions and don't send in any money. Well, then what was the purpose of the extension? The extension is saying, I need time to file the paperwork, but here is your money. So if you're not sending in any money with the extension, then you have just wasted the paper. You didn't need to ask for an extension. And if you are receiving a refund, you also don't need to ask for an extension because you have 3 years to ask for your refund. You have 3 years from the due date. So anyone who hasn't filed their 2021 tax return, I think it's the 2021, because we're filed, no, the 2020 tax return was due in 21. That means it has to be filed by 24. You only have 3 years to ask for a refund on your taxes. Any questions on what I have gone over so far? The extension of time to pay, it doesn't grant the extension of time to pay the government. It only extends your time to do the paperwork. Any questions on that? Next thing, if you collect unemployment compensation, yes, it is most certainly taxable. I remember during the pandemic, they gave persons, I think, $10,000 that they didn't have to pay taxes on the first 10,000 of unemployment, something like that. Don't quote me, but it was a large amount. But that's no longer the case. As far as they're concerned, pandemic is over, and y'all gonna pay taxes if you collected any unemployment. Now, you can ask, if you are collecting unemployment, you can ask them to withhold taxes. So you don't have to, the same thing with Social Security. There are many other persons collecting Social Security. Everyone thinks that Social Security money is tax-free. Happen to know that that's not true. If your other monies, if your other income, whether you're receiving money because you have military pay, retirement, or VRS retirement, or you done retired from OPM, the government, if that money is over a certain level, and I think it's 25,000, then it makes a portion of your Social Security money taxable. But most people don't realize that you have to say to the government, to the Social Security Administration, I need you to take the taxes out. They're not going to automatically take the taxes out. You have to say to them, I need the taxes withheld, because they do not know your situation. And when I get later on, when I get into tax rates, it's like when we're at work every day and then all of a sudden you get a paycheck that's a little bit higher. I tend to wonder how many folks think they just got a raise, because you didn't just get a raise. What happened was the government changed the tax rates, and then lowered the amount of taxes they're going to take from you at work. You never paid any attention to it. So you're thinking, oh, I'm bringing home a little bit more money. Well, that's designed to make you break even with them, because they don't want to owe you any money at the end of the day. They don't want to owe you anything. So that's why they're changing the tax rate. So we have to be the smart ones and say, you know what? No, I think I need to have a little bit more taken out. We are able to still deduct charitable contributions, and that is only if you itemize. Now, I don't want to have to say it. I'm going to say it again later because I'm going to prove my point. But those who itemize are at an advantage for the federal side and on the state side, because itemizing allows me to reduce my income by more than what the government standard deduction is. And so the more I can reduce my income, the lower my tax bracket will be if I'm able to reduce my income. So we're going to have to understand that giving away and everything given away, I've said this before, it doesn't mean cash money. Giving away, yeah, sure, we want to help pay our money at church, and yes, we want to give to United Way, but how about them clothes you ain't wearing up in your closet that you need to inventory, put in a bag, and
To
drop
you all's from
LaGrace, I need you to mute, please.
Kuwait, because I was in Kuwait at the time.
LaGrace, I need you to mute.
Mm-hmm. I sure did. Mm-hmm.
Somebody needs to mute, please. Thank you. So anyway, you have to be able to itemize. The only way you can itemize is the only way you can take off deduction for charitable contributions is to itemize. If you do not itemize, I don't care what you're donating, it's not coming off. You're not getting any more of a deduction. If you're standard, you're standard, you're standard. But I'll be able to show you in a little while exactly how devastating it can be in just a little while. So what I need to know, I'm going to be quiet. Do I have any questions on what I have gone over so far? As far as what you need to know for the federal side of the house. I am going to get into the state, but the federal side of the house takes a little longer to teach it. So any questions so far?
No,
Okay.
no questions. No, Gwen, no question. But I just want to, everybody could just mute. Make sure that you're muted.
I got someone named Melanie that's not muted. I can't see everybody, but I need folk to mute. Thank you.
When you can't mute everybody?
I don't know how. How do you mute?
All.
Yeah, we made you the host, so
You
the
can
ability
mute
to do
all.
that. Is
Oh, I
mute.
can mute everybody?
Mhm.
My husband's gonna have to show me how to mute everybody. I don't know how to do that. James, how you do?
I think you can, Gwen.
Or Gwen, you can make somebody else a co-host and they can meet people for you.
Okay, thank you. So one of these down here, Dan?
I'm not gonna mess with your screen right now.
Oh, because it's up here. Here it goes. Here it goes. Up here.
Right there.
Oh,
Drop out right there.
that's muting me. So it's not.
Everybody.
Okay. Okay, let's go. Can I mute everyone else? Okay, I'm not gonna worry about that. I gotta keep moving. Okay, so I put this one up, mortgage insurance premiums. A lot of people, especially those who are purchasing homes or who have already purchased a home, and sometimes when you don't put down a certain deposit on your new home, they charge you what's called mortgage insurance premiums, which is a third party guaranteeing that the mortgage will be paid or something. So there's a premium that you're paying for that insurance. At one time, that insurance premium used to be deductible only if you itemize. And now it's no longer deductible.
I went out in the car and I saw your tax. I'm like, I can't see it.
That's ridiculous. We don't never have this problem. I need Melanie.
It needs to change.
So what did you say then? I know. The next issue I'm going to go over is residential clean energy credit. So I know a lot of you have heard about these solar panels people are putting up on their houses because the government's going to give you 30% of the installation cost, and there's no cap on the credit for it. I cannot get into it a whole lot because I don't know a whole lot about it. I just personally have not been convinced that it makes sense. But that's just me personally. I can't tell you what to do because some people see that 30% credit and like, yeah, but why? But you spent 50,000. Okay, so I'm trying to figure out how do you in a lifetime do you get your 50,000 back? I can't answer that. The next thing that they have going on right now is those of you who are purchasing the electric vehicles, Tesla or whoever else makes them, that now you can get $7,500 maximum credit for purchasing the plug-in electric vehicle, but now also they look at your income. So I don't know the figures at the moment off the top of my head, what that income is. I want to say for a single person is about 150,000. That if they make that or more, they will not get the credit, or the credit gets reduced, one or the other. So I do know that part. Before I get into credits like child tax credits and earned income tax credit, are there any questions on anything that I've gone over so far before I move on for you?
Grab my tablet and then go time to.
Okay.
I'm going to tell you to say goodbye to the pandemic tax credits because many of the tax breaks expired. There were no stimulus checks issued in 2023. So therefore, we have gone back to pre-COVID levels. So if you look at the chart, you will see the only thing that went up is that those persons who do not have any children that are eligible to collect earned income tax. That's what the EITC is, earned income tax credit. They raised you from getting $500 last year to getting $600 this year, but it's based on your income in order to determine whether or not you will collect that money. So I wanted you to see that for a minute. Before we get into your homework, and Esther, I need you to mute. Esther, I need you to mute if you can hear me. So before I get into the tax brackets for 2023, I just wanted you to see the child tax credit, 2,000 per dependent, the child dependent care, 2,100 maximum, before we learn about the tax. Because the tax brackets will determine what you're going to pay in the way of taxes. So we're going to do a little homework. As long as you have your paper and pencil ready, I'm going to teach you a little something as soon as I go over this next chart. I need you to pay attention. I don't expect anyone to memorize this chart. I am going to help you. But one of the things I need you to really see that there aren't but 7 tax brackets. There are 7 tax brackets. The lowest one is at 10%. Everybody see that the lowest tax bracket is 10%. The highest tax bracket is 37%. Okay. And the definition of taxable income is what is your income at the end of the day? At the end of the day, how much were you able to reduce your income down to in order to determine what your tax rate is going to be? Because if you take the
1,099 miles.
standard deduction, then you may be losing out. You may be paying a higher tax rate than if you had taken the standard, if you had been able to itemize. Because if you're able to itemize,
go zero. I just want to see for
I'm
Then-
sorry, Gwen, we can't hear you because someone needs to mute.
okay, I'll tell you what, I'm gonna take a break until I can mute everybody because this is pain. I have never experienced this
Okay, all right,
in my
thank
life.
you.
No problem.
Every year I do this, I don't have people's mute their somebody's not hearing me. Or they're not paying attention to what I'm saying. So let me stop sharing for a minute. I'm gonna stop sharing for a minute. And then I'm going to
I don't see
see
any cracks.
figure out how to mute
It looks like
everybody.
it may have been
This-
Gwen, and then that spot
Yes.
that you saw.
Maybe they don't know how to mute. Maybe
Okay, so at the bottom left corner of your screen, there should be something, there's a picture of a microphone, and you have to hit it so it mutes. And so the people I see right now that have not muted include Esther Hines, Nancy Walden.
That's it here.
Calling y'all out because I need everyone muted.
Gwen, if you want to make me the host for a minute, I can mute everybody.
Okay, how do I make you the host?
Go to your name on the participants list.
Okay, go to my name.
Yes.
Oh, on the participants list. Okay, I got it. Okay.
Mhm. And there should be 3 dots. Click on that.
Okay.
Everything good?
Oh, I see
Beside your
host.
name.
I see the 3 dots.
Not working right.
It might say you can mute everybody, but if you make me the host, I can mute everybody.
It's okay, yeah, it's okay for now.
Spotlight for everyone and remove.
So, like I said, since we're having the vehicle for a
That's
couple
all
of
the
days,
options that she has.
I run myself for a couple of days at a time. But because
Okay. Oh, I see. I can mute people
No,
now.
but don't. Yeah.
You can mute all.
Esther's muted now.
No, you need to.
she sure is.
Not Michael Dawson.
You know, listen. Go up to the back over here. Hit
Back
the three
here.
dots.
Hit the 3 dots.
Okay, now go back over here. Hit mute. That's you, I know. Okay, it's the 3 dots. That's what you don't like you have.
Okay, so I'm
Looks like everybody's
I just muted everybody. Everybody's muted now. Okay,
all
everybody's
right.
muted.
Back in business.
Whew. Lord.
Okay.
I'm going back to share screen. Let me go back to my. Okay, so everybody can hear me fine. I don't expect to hear back from you. I'm just gonna assume everyone can hear me fine. And that's much better. Oh my goodness. So anyway, this is the screen where I need you to I'm not expecting you to memorize a thing, but we're going to go back to this screen because I need to teach you something. And what I want you to pay attention to is right here where it says single. I need you to go down to where it says 12%. And you will see that if this person's income is no more than $44,725, they're going to pay 12%. Guarantee you. But if this person's income just goes up by $1, just $1 taxable income, look how the percentage, their tax rate has jumped to 22%. I need y'all to see that. This is the biggest jump there is in the tax rates, going from 12% to 22%, and the difference only being $1. I need that to soak in a minute, okay? Because I'm about to prove a point with paying taxes on paying 12% versus paying 22%. So get your paper ready because I'm going to prove it in a minute. Okay, so now let me go to my next screen. So this is what I need you to see. Pay attention to the year 2023. A single person's standard deduction is $13,850. A married filing jointly is $27,700. That's twice as much as the single. But then a head of household is $20,800. Now, The little note at the bottom is to tell you that for married couples, or even if you're single and 65 or older, or you're blind, your standard deduction goes up by an additional $1,500. So that it's good and it's bad. It all depends on your situation, okay? But I need you to understand, especially this $13,850, the $27,700. So this is what I want us to do as a piece of homework, just so that you'll understand what I'm trying to prove. So for all of you who are able to write down what I'm about to tell you, please follow me and write it down. Let's just pretend, I'm gonna pick on a single person right now. And I want to pretend that this single person makes $60,000. So let's just write down $60,000. Write down $60,000. And the chart that I have up here for you shows you that this single person now is able to reduce their income by $13,850. So we're going to subtract that out. And so now their taxable income is $46,150. Their taxable income was $46,150. So now I'm going back to the previous chart. So if this single person made $46,150, I want you to see that they sit here in the 22% tax bracket. 22% tax bracket. Because their taxable income is $46,150. I need everyone to see that under single. But guess what? If we could have itemized and had a deduction of additional $1,425. So I'm gonna go back to my next chart. And instead of using $1,308.50, let's pretend they itemize and let's take off another $1,425 off of their income. And now we just got them down to an income of $44,725. Just to itemize $1,425 more. So that means that they had to itemize $1,425 plus the $13,850. So they need itemized deductions of $15,275. Now let me, I'm gonna prove it to you in 1 second. I'm going back to the chart. If your income is $44,725 right here, you wouldn't be paying but 12%. You would not be paying the 22% I just showed you. What a difference. You would pay 12%. So now, but how does that single person get $15,275? Well, let me just throw a couple of figures out for you. Let's just pretend they're paying for their first condo, their first house. And let's just pretend their interest, the mortgage interest alone for the year is $12,000. Well, how about the taxes that came out their paycheck? Well, if they made $60,000 and they live in the state of Virginia, $3,000 should have came out. 6 times 5, $3,000. So you take $3,000 plus another 12. How about give the church 10%? There's no reason why you shouldn't have been able to itemize. That's just an example. It doesn't have to be all those, but just imagine someone who actually gives the church $6,000 a year. And all they got to do now is find another $9,000. And 3 of it already came out their check now, so they need to find another 6. By the time you pay taxes in the state of Virginia on your vehicle, how about the taxes, real estate taxes on your house? You should be able to itemize. And I'm promoting itemizing because that is the way to pay less tax. So now, let's pick on a married couple. I don't pick on, because married couples have it even harder. Because now that's 2 single people. It's double. It's double. It's double. But let's try this. I'm going to my next chart, and I want to show you that married couples need to are going to get a standard deduction of $27,700. That's 27,700, and that's a large number. I'm not knocking it. It is a large number. It is a large number. But let me try to prove my point with you with this large number of 27,700. So let's pretend that this couple made twice as much as the single. I'm gonna pretend, let's start with 120,000. So let's put $120,000 on our paper. And let's minus out the standard deduction, which is 27,700. 120,000. And we're going to minus out 27,700. And we should now have taxable income of 92,300. So I'm going back to my previous chart. And a married couple over here in the right that makes 92,300 taxable income is paying 22% in taxes. All we got to do is get that person, married couple's income down to that 89,450. Well, that's only 2,850 difference, $2,850 difference. So if I take $2,850 plus the 27,700 that they give us, we need to itemize 30,550. So can we itemize 30,550 for a couple? Well, let me show you how it's possible. If you're still paying a mortgage, and what I know about mortgages right now, so if you're still the average person is paying $1,000 a month in interest on their mortgage. So if you're paying a mortgage and you're putting out, I'm around it to 13,000. So let's pretend we're paying out I need you to write this on your paper. You're paying out $13,000 in mortgage interest. I then need you to write down, you're going to be paying out at least $10,000 in the area of taxes, because taxes means the real estate taxes on your house, the taxes you paid on your vehicle, and how about in the state of Virginia, they took 5% of that $120,000, okay, which is probably another $6,000. You have $10,000 in taxes. So now if you take the 13,000 I told you, plus another $10,000 in taxes, well, that's 23. How about get a church $8,000? Get a church $8,000. Is that not $31,000? So now, if I can reduce my income by 31,000 from the 120,000, guess what? My taxable income is 89,000. And guess what? My tax rate is now 12%. It is no longer 22%. 22% is, I'm telling, if you sit between this 12% and that 22, you need to do something about it. That's the best I can say. You really need to do something about it, because you're ripping yourself off. I don't know how else to tell you, because it doesn't take but a little bit more to make a difference here. Now, if you're way down here in this 35%, I can't sit here and tell you how to fix that. I'm just dealing right now with the folk right here that got this 12% versus 22%. That is the biggest one. And so if you're in between those two numbers, you really need to understand what to do. Okay, so I don't mind if we unmute or put it into the chat if you have any questions about this, because this is very important when it comes to what's going to be your liability to the IRS. Your liability to the IRS is how well you can get your taxable income down to a level that reduces your tax rate. And so this chart is showing you that those single persons who are making, $44,000 should only be paying that 12%. I mean, I'm saying if your taxable income is 44, that's not what you make. That person, I had that person making $60,000. I had the married couple making 120,000. And I could show you that I can get you down to 12% versus paying 22%. So that's what that presentation was for. I need you to see the most, if I don't talk about nothing else on this tax workshop, that is the one that's going to really, really make a difference with your taxes, is the ability to not use the standard deduction, but to be able to itemize your deductions. I'm going to go to the next chart, which talks about those who are eligible for earned income credit. And you will see the best way to read this is that if you do not have any children, but you are single or a head of household and your income is not over $17,640, they're going to give you enough to buy next month's groceries. $600. They're going to give you a credit of $600. If you're single and you have no children, a lot of people don't know that you still can get earned income credit and have no children. But if you're married and make $24,210, you'll still get another $600. And then likewise, children, you have one child, then your single person can make $46,560 and collect up to $39.95. So these are the maximum tax credits over here on the right. It's on a scale based on where you fall on that scale as to how much your credit shall be. And notice my note at the bottom. So they're paying attention that if you got investment income of 11,000 or more, you don't need no earned income credit. Okay, let's just soak that in for a minute, because the banks ain't paying 5%, 4%, whatever they pay. If you are receiving $11,000 or more in interest income, dividends, whatever you want to call it, that's investment income, you do not qualify for earned income credit. That's exactly what that's saying.
Hey, Gwen,
Yes, sir.
there's a question in the box from chat from Patricia Brown. So can a married couple go back and redo last year's taxes and items?
Yes, you can. You can go back, and the only thing at one time they wouldn't let you go back and change your status. In other words, a married couple could not go back and say, "Oh no, we want to do married filing separately." You couldn't do that, but you can fix a tax return because you forgot to claim something that was claimable. Sure, you can. That'd be like, you can also go back and redo your taxes if you forgot to report some income that you became aware of later. Or like those of us who have investments, we're supposed to have our paperwork from the people by the end of January, and then they wait to the end of March and say, "Oh, by the way, we made a mistake. Here's your new one," and you have already filed your taxes. So yes, you can go back and fix that because itemizing does make a difference. Any other questions in the chat? No? Okay. So I'm going to go on to the state of Virginia. I can't do every state, but the state of Virginia, so that we can see what they have done to help us. Standard deduction is $8,000 for individuals and married filing separate. And it's $16,000 for those married filing jointly. Okay, here I go again. Somebody needs to mute, please. Kimberly or whoever DJ is needs to mute. So the standard deduction is $8,000 for single and $16,000 for married filing joint returns. The one thing I will say about the state is that they have not yet caught up with what the IRS has done as far as persons standard deductions, and they probably never will. I don't even see it. Part of your problem is that they have not figured out how to help those who now have been pushed into another category. When I say another category, what I'm speaking on is that we used to have a lot of people who could itemize their deductions because they had enough to itemize with. And if you itemize on your federal return, that means you had to itemize on your state return. But now, and it's always been true, that if you do not itemize on your federal, you cannot itemize on your state. You must do the same. Which then brings me to the other point. There are people who don't realize if you file married filing separately on your federal return, both of you must do the same thing with regards to standard deduction or itemize. One can't itemize and the other one do standard. It'll get kicked back. Impossible. Whatever one does, so you have to have an agreement. If y'all married, filing separately, you must agree before you ever do the tax return. Are we going to itemize these tax returns or are we going to take the standard? Yes, you can itemize and still have less than the standard because you have to do what your spouse does. Both of you have to do the same thing. Married, filing separately. Okay, so I'm gonna jump back to the state now. Their filing deadline, of course, for the state of Virginia is May 1st. You do not have to ask for an automatic, you get an automatic extension for 6 months. You don't have to ask for it, but your taxes, the taxes owed must still be paid by May 1st, whether you file the return or not. And there should be a way to go online to the Virginia Department of Taxation and pay your taxes online. Or you can print off probably a estimated tax voucher and pay it that way as well. But there is a filing deadline. Now, Governor Youngkin, these are the people he has helped. One day, if I get a chance to, I need to write him a letter because only, and I ain't mad at you, only those receiving military pay, military retired pay, but you have to be 55 or older. So now that's the other issue I have with this. And that's because you have veterans who are receiving retired pay who are not 55 years old. And my question is, why does it matter? Why should it matter what your age is? If you're receiving retirement pay, it's the same money. But this year, if you're age 55 or older, Youngkin is allowing you to reduce your income by $20,000, the first $20,000 received in military retired pay. That's a good deal because last year that amount was $10,000. Next year, for the year 2024, that amount will be $30,000. And for 2025, it's going to be $40,000. So just imagine if you're receiving a military retired pay, the state of Virginia, hopefully your tax preparer knows it because there ain't nothing on that tax form telling you, hey, by the way, are you a military retired pay? It don't even recognize. You have to know. Your tax preparer needs to know that that you're entitled to that deduction for military retired pay. Wow. That's
hey,
a
Gwen,
good, yes.
Hey, Gwen, in the chat, David gives you a thumbs up. He wholeheartedly agrees to the point you were just making. So I just want you to know that.
Yes, that right there, the age thing, I don't get it. I really don't get it. But I don't work for the state. Ain't nothing I can do about it. But when I saw it, I said, well, what? Because I actually prepared a tax return this year. I just did it about 2 weeks ago from a young lady that on January 1 of 24, it asked you, what was your age? No, January 1 of 23. It wants to know what was your age on January 1 of 23. She was 54. And she could not take it. It's what your age is on January 1. So I couldn't take that $20,000 off for her this year. Now she'll get it next year. But that was a shame That's what made me see that. I was like, what in the world? No, but this is from those who are just receiving retired pay for military. This is military retired pay. Yep. Okay, so anyway, any other questions in the chat? Okay, so I already went over this, that if you itemize on the federal, you must itemize on the state. But there are some additional deductions you can take if you cannot itemize on the federal government. And this deals with those who are licensed school teachers who have unreimbursed tuition costs. There's a way to deduct 20% of that amount. Another thing you can do on ours, and this is my favorite, because you know, the little story I need to tell you is that when we were growing up, those of you who are about my age, what was being promoted by insurance companies was actually life insurance. Life insurance was promoted because you got to, not only we got to be able to bury you, and then you also got to be able to take care of who's left here. Well, I dare to differ a little bit, but I'm not gonna get into that subject. But the point is that we were taught to make sure you buy life insurance, but we were not taught to make sure you buy long-term care, because the probability is that you're gonna become disabled before you're gonna die. Not for everybody, but the probability is that you will become disabled and you will need a nursing home, or you may want to stay home and have someone come take care of you. The point of the matter is that's very expensive, averaging $5,000-$6,000 a month right now to have someone keep you around the clock. Whereas this is insurance that would have taken care of most of that cost. This is insurance that the state of Virginia says, if you were not able to itemize it on your tax return, whether you itemized or not, if you did not get the deduction on your federal, we're going to give it to you on the state. And that's a good promotion for the state. I give them kudos for that particular one, because premiums are not cheap. It's based on your age and based on how long you've been paying it. But it's worth looking into long-term care health insurance, because the probability is that you're going to need that before you need life insurance. Or some of us got too much life insurance. That'll be the other thing, but that's a whole nother workshop, and I can't do that one. But I'm just saying, we probably got too much life insurance instead of taking some of that coverage and cover ourselves with long-term care. Those of us who have purchased energy efficient equipment or appliances, the state is giving you not 20% of the cost of the appliance, but 20% of the sales tax, okay, paid. It's not 20% of the appliance cost, it's only 20% of the sales tax that we are paying on that. That is what will be deductible for the state of Virginia, up to $500, $1,000 if filing a joint return. The Virginia College Savings Plan. This is another one where we're allowed to, our grandkids, we put money into the 529 account. These are the 3 different accounts that I'm aware of at the moment. But we're allowed to take $4,000 of our income gets reduced up to $4,000, depending on how much you place into those accounts. And that's per child. Okay, that's per account. Okay, so we're allowed to reduce our income for the state of Virginia if we invest in their college education. Now, this is the one thing I have a problem with the state of Virginia. I want you to pay attention to this very closely. Notice that there are only 4 tax rates in the state of Virginia: 2, 3, 5, and 5.75%. I need you to also notice that they don't care if you're single, head of household, or married. We all gonna pay the same rate. It's just based on what's our taxable income. but we all gonna pay the same rate. So something don't sound fair to me, because that's not the case with the federal government. Your rate changes based on whether or not you're single or married. Because married should be twice as much as single, you would think, but not for the state of Virginia. Your tax rate is based on what your bottom line income is for the state. It's no way around it. The only way around this, to be honest, is to be able to itemize your deductions to get your taxable income down as low as possible, so that when you apply the state rate, you're applying as low of a number as possible. But guaranteed that the majority of us have taxable income more than $17,000. What you think? The majority of us got to have income more than how do you even pay the rent? I mean, the majority of us got to have income more than $17,000. So I would dare to say that the majority of us are paying 5.75%, because that is what they have defined as their tax rates for the state of Virginia. I don't know any other state off the top of my head, but that is the state of Virginia. Any questions so far on the state before I get into, because my next subject to sum this up for you is actually going to deal with how to avoid processing delays, because we cause our own delays sometimes in processing our tax returns. So if there are no questions, do you see any questions in the chat on the state, or any other questions will be fine, but I just want to make sure. Okay. So these are some suggested tips, steps to take now to get ready to file your taxes and avoid your processing delays. There are a lot of things.
Gwen, there's a question in the chat.
Say again.
There's a question in the chat.
Yes, ma'am.
From David. He has a question on the previous slide. Just wanted to be clear. If I'm a grandparent and contribute to my grandchildren's 529, let's see, I can claim tax exemption.
Yeah, you can reduce your taxes by up to $4,000. So you're allowed to put $4,000 into one of those accounts each year and reduce your income by the $4,000. But if you don't put in but $2,000, you can't reduce but $2,000. But the max you can put in a year is $4,000. Does that answer your question, David?
Where's David?
Yes, it did.
Thank you.
Yeah, thanks a lot for the information too.
Oh, you're
and
welcome.
the clarification.
So I was saying that a lot of times, you know, we can answer some of our own questions by going on to irs.gov, because there are some things on there to help answer some tax questions. This next one, as far as gathering your information, because keep in mind, whether you're preparing your taxes yourself or someone else is, if you don't give them the information, there's no way they can accurately prepare your return if they're missing something. So it's up to you to gather for them all of your W-2s, 1099s, dividends, interest, Social Security statements, all of that good stuff. And see, I have a habit. Every December, I have this envelope that every time something comes in the mail starting in January that says important tax document, I don't even look at it. I just put it in the envelope. I just put it in the envelope until it's time for me to prepare the taxes, because it's got to have something to do with preparing those taxes. So that's a way of being organized, to place everything in one location so that you can put your hands on everything when it's time to prepare your taxes. Now, if you itemize, yes, you have a little bit more homework to do, because the other day I received a new client that I had to call up and tell them I'm gonna bring them back their stuff because I'm not getting ready to add up your prescriptions. I'm not getting ready to add up all your co-payments to the doctors, okay? You need to tell your preparer how much did you pay for prescriptions. We could care less whether you went to Rite Aid, CVS, or anywhere else. We just need to know the total. What did you can't expect us to sit here and add up all your prescriptions. The same thing with doctors. You know, add them up. Say this is what I spent in co-payments. This is what I spent in medical equipment. This is what I spent on insurance premiums because everyone's not on Medicare. Some of us are paying out of our pocket for Blue Cross Blue Shield, for example. Those of us who are working W-2 forms, most likely your medical premiums are pre-tax. So most likely your W-2 went down by your taxable, W-2 wages, block one, what should have gone down by the amount of your premiums that came out of your paycheck to pay for your health insurance. You need to verify it because you're supposed to have what's called pre-tax W-2s for your health insurance. It should be pre-taxed. So therefore, you can't take it off twice. If your W-2 already reduced your income by the medical premiums, you can't turn around and tell your tax preparer, oh, by the way, my medical premiums were X amount of dollars. No, you can't claim it twice. It only can be claimed once. But then there's some of us who are paying for houses where we have mortgage interest. We may have opened up a line of credit, an equity line of credit. That's also mortgage interest. We may have personal property taxes, real estate taxes. So those types of things are information. The more you can find, the better. And the biggest one for me is actually contributions, because contributions, no one gives away 60% of their income. You can't even live. You can't give away 60% of your income. So therefore, I can actually say most of us can take away everything we've contributed because 60% of your income is a lot. That's a lot. I just can't imagine not being able to take away all of your contributions. And the more you have, the better, because it then qualifies you to be able to itemize your deductions. The next thing, I had folks think that you can't, they don't want you put down their bank account number and route number, account number on the tax return because they don't want IRS to know their information. Well, guess what? IRS can tell it to you. IRS already know all your information. You ain't hiding nothing from the IRS. They already know what your account numbers are. They know every investment you have. They know it already. So what you think you had? You're not hiding anything. So yes, direct deposit is the way to go. It's the fastest way because guess what? You will hold up your refund if you don't ask for direct deposit, because now it's got to go to a whole nother department to cut you a check. And then you got to wait for the check to get mailed to you, and the post office is having a problem. So now you're going to be a minute trying to get back them $5. You understand? You're going to be a minute. Instead of just saying, here is my account number and my routing number. Go ahead and put it on the tax return. Same thing happens to those who owe. Sure, if you owe, yeah, some of us say, oh, you know what? Just print me off the voucher. I'll mail the check in. Why? Why not say to the IRS, take it out on April the 15th? That way you ain't got to remember this mailing in. Those of us preparing taxes can tell the system, yeah, we owe you $100, but you can get it on April 15th. And we can tell you, take it out on April the 15th. And they won't take it until the day we say. But you don't want to take it now because you don't want them to have the account number that they already got. Doesn't make sense to me. But anyway, I just thought I would give you that little tidbit. File early.
Gwen,
Yes.
there's a couple of questions in the chat.
Okay.
Carla asks, for the VA College 529, don't you need to be the account owner? I understood that if you just give without being the account owner, then you can't deduct it. Also, can I still contribute to my child's 529 investment account after he starts college?
Okay, so the first question is, yes, you're absolutely right. You have to be the account owner for the account, but you have to put down who it's for. So it has to be a grandchild, you know, someone. I don't know if you can do it for strangers. I never looked into that. 'Cause I just can't imagine paying college for strangers. But I do know that you can whatever you put down, you have to be the owner of the account. Now, as far as being able to put money into an account after they start college, okay, you're going to have to contact them for that one. I really don't know, because I thought the purpose of that
Yes.
was to prepare them for college.
And
It's
Gwen, we know from personal experience,
We're-
yes, we can.
We have kids in college. We have 3 in college at the same time.
okay.
we
So what's
just-
the answer? What's the answer?
Yes, you can still contribute.
Okay,
As
you
long
still
as
can
the money
contribute.
is used for college.
All right, thank you. As long as it's used for college.
Mhm.
Okay, thank you.
Because what we're doing is we're loading them up, and then we use that for the last year, because you
Okay.
accumulate.
And so you can keep doing that until they finish college.
Mhm.
Okay,
And that
very
post, you
good.
can do it for post-secondary education too. So,
Okay, very good. Thank you for answering that, because I had no idea.
Yeah.
and there's another one, Gwen. Reverend Boyd asked, is there a limit of medical expense that can be used?
Okay, so the way medical expense works is that once you key in, and medical only works if you're going to itemize. So if you're not itemizing, medical means absolutely nothing. So, but if you are itemizing, there is no limit on how much you can put down for prescriptions or the monthly premiums you're paying for health insurance, or how much you're paying in co-payments to your doctors or to the labs. There is no limit. Your problem is that most people cannot get a deduction if their medical total does not exceed 7.5% of your income. So that's a high number if you think about it. So for every $100,000 that you make, your medical has to be over 7,500, and only that which is over the 7,500 comes off. All of it doesn't come off. Only that exceeds 7.5% of your income.
Gwen, also Nancy Weldon says thanks. And then Melanie Bryan and Reverend Boyd just said thanks. Melanie Bryan asked, out-of-pocket medical payments are deductible any amount, and is that federal or state?
Okay, so what happens is, on the federal government, you can deduct it providing you can fill out Schedule A, which is your itemized deduction. There's a whole section on medical expenses. And so in our softwares, it keeps track of all your medical. If you tell me you spent X amount of dollars on prescriptions, you spent X amount of dollars on your premiums, we already know if you have Medicare money coming out of your Social Security check, because that's on your Social Security 1099. So it tells us that. So it had the system adds all this medical up, and it then subtracts from it 7.5% of your adjusted gross income, not your taxable income, your adjusted gross income, which is really all your money before you reduce it by standard or itemized deduction. It's going to look at that figure. If that figure is $100,000, like I said, your medical will come off, no limit, providing it exceeds 7.5% of your income. Any other questions on that?
It's better to get an HSA.
That's all the questions. Kimberly, do you mind muting? Kimberly?
Can you hear me?
Yes.
Yeah, we can all hear you.
Oh, sorry. I'm in the car. Let me see if I can, I don't know what to do. Yeah, sorry about that.
Okay.
I thought it had me.
Thank
Okay,
you.
you're done. Okay, so what I was saying earlier is that you want to file early. And if you are requesting earned income credit, it's going to take longer to process your return, because there's so much going on with fraud that they have got to make sure you're legit and asking for earned income credit. the next one I have on here is downloading on the app IRS to go. So you don't have to call your preparer and say, where my refund? Because you call me and ask me where the refund is. I'm gonna tell you where to go to find the refund because you can't. On back online at irs.gov. The only thing it's going to ask you for is what was your marital status and how much, what's your social security number, the first person on the return, just theirs, and what was your expected refund. And once you know the answer to those three questions, which I'll repeat, the three questions are for irs.gov under where's my refund? What is the first person's social security number that's on that form on your 1040? That's the first question. The second question is, what was your marital status when you filed it, whether it was single, head of household, married, filing, or married, filing separately? And then it's going to ask you, what was your expected refund? When you know those three answers, it will tell you the status of your refund, whether or not it's still being processed or hopefully don't say we ain't get it yet, because you don't want to hear that one. But hopefully they'll be able to tell you, or it's being sent out next week. The last thing on here is to consider signing up for identity protection. I do actually have a relative that has gone through this and had their identity stolen to the point where someone else filed a joint tax return in their names and asked for a refund of $10,000. And the IRS just so happened processed it, and actually whoever stole their identity was not smart enough to change the banking number, and the money came to my relative's bank account, the $10,000 from the IRS. I mean, how stupid can you get? But anyway, neither here nor there. My relative was like, oh, I know there's a mistake because I ain't supposed to get nobody $10,000 from the IRS because every year I normally owe the IRS. The IRS never owes me. They never owe me. He said, but we got $10,000. So they called up the IRS. The IRS will not reveal to you who did what, as far as fraud, because they're going to investigate. They're not going to tell you who filed that tax return. As soon as you tell them it was not you, that's all they need to know. So now every year, my relatives get a identification protection number, which I think all of us should have a 6-digit code. And I cannot e-file their return until I put in the 6-digit code for each of them. The husband and the wife each have their own separate 6-digit code, and that code is mailed to them every year to prepare the taxes. I think it's a good thing, unless you don't receive your mail. Then it's not a good thing. Or the envelope go to the wrong person. It still won't be a good thing. Okay? But at least it's an attempt to try to protect your identity. So now, I have tried my best to enlighten you on what I know. I know I didn't cover everything there is to know, but hopefully you learned something, especially those of you who are sitting between that 12% and that 22%. That, if you ain't learned nothing else, get your numbers fixed, because that's a big difference between 12 and jumping to 22%, especially if you fall within or close to those numbers on that chart. So now's your opportunity for any other questions, because that's the end of my PowerPoints, unless I need to go back to it. So I'm open for questions if you have any more.
Everybody needs to unmute. If you have a question, just go ahead and unmute. Now's the time to unmute.
When you can unmute everybody.
I need to go back on to unmute everyone.
You can ask everybody to unmute.
Right.
Oh,
Yeah.
okay. Everyone
Okay.
go ahead and unmute, and then we'll
Yeah.
answer questions.
Wait. Yeah, this is David. I'll tell you, it's great information. Greatly appreciated Job well done. I definitely I got some things that I can actually utilize for myself on this tax year. All my question was answered. Greatly
Well, thank you,
appreciated.
David. I'm glad you enjoyed it. I see Alberta Foch has her hand raised, Bert.
Yes, she does. Two
Okay.
things. Can you go back to the slide about identity protection? And then can you go to the slide that gave that tax chart? I just want to take a picture of it, please.
Okay, so the one that gave you, the one about identification?
Yeah.
This one right here, consider signing up for the Identification Protection Opt-in Program. Okay, you go take a
Yes, I
picture
know
of
you
it.
can tell me how to do it, but you're gonna say you didn't get it off the screen? So write it down.
Yeah, you know what you're gonna say.
Yes, I really do.
All right, and now you want me to go back to the one that said the tax rates?
Yes. Because I want you to get me to 12%. I'm just gonna take
Bring all the
We'll take a
receipts.
picture.
Bring all the
Right,
CVS.
there you go. Yeah, we all
the CVS receipts.
So nobody with my real sister would ask me to do that. I gotta get you to
Thank you.
All right, we gotta get you. So I mean, we gotta get your taxable income down to 44,725. Really?
Yeah. Can we work on that?
Oh, really?
Not working, honey. All right, I got it.
Woo.
Got some work cut out for you.
Yeah, I got work cut out for me. That one. Somebody else put something in the chat.
Yeah, Marion and Renee Macbeth, they asked, what is the deadline for charitable contributions for 2023? Was it December 2023?
It was December 2023. Sometimes I have seen, because I know that the IRS allows, for example, the IRS does allow for us to put money into an IRA after the year is over, as long as we tell the financial institution to apply it to the previous year, then we can get that done. So if you were making a large donation, I would say to an organization, they're the ones that you would have to request to record it into the previous year in order to get credit for that previous year, because all you would have right now is your canceled check or Cash App or however you sent the money, which is date sensitive. So it's the organization who receives it will have to acknowledge that you wanted it applied to the previous year in order to deduct it.
All
Did I
right,
answer your question? Yes.
we also, Talicia Parham said, thank you so much. Very informative. Sharon said, thank you so very much. Esther Hines asked, how can the recording be accessed? This is going to be uploaded on the church website, also on YouTube. You can just search it.
Third Street Bethel.
Third Street Bethel AME Church. If you need, and we can put information, send that back out and how to access it as well. But go to YouTube, you can find Third Street Bethel AME Church, you can find it. I believe there might be a link on our website as well.
Right, but you probably about to give it probably about a week, because David's got, Yerby's probably got to post it, right?
That's correct.
Okay.
All right, any other questions or comments? Susie Perry Fikes says, thank you so much for this valuable information.
You're welcome, Susie.
And Reverend Boyd said, thanks to the Finance Ministry and Sister Carney for great information.
You're welcome.
And then iPad 2 said, great presentation. Thank you, Gail Browley.
Yeah, thank you so much. Well, I hope everyone learned something, but this is my favorite chart that I still have up. 12% versus 22%. That's my favorite chart. If you can get that number, whoo, and this is this is not income now. This is taxable income. This is after you have deducted your itemized deduction. I'm telling you, you have to get it down there.
So if you make $200,000 a year, but you can itemize to get down to a taxable income.
That's right.
Less than 44,000.
That's right.
You only pay 12%.
You only pay 12%. Absolutely. That's exactly how that works.
Yep.
But look at married couples. Married couples, you gotta get your income down to 89,450.
Mm-hmm.
89,450. So you could, but that's probably gonna require itemizing.
Yeah.
You're not gonna get it down there with no standard deduction. It's
That's
hard.
true.
You need to itemize. So
Itemize.
yeah.
And any other thoughts or comments? Veronica Carter, Reverend Carter says, "Great job, Sister Gwen. Thank you." With a
You're
whole bunch of
welcome.
exclamation marks. And Joanne Knox says, "Thank you so much. I learned something too."
Thank you.
We're just checking to make sure we got all the chats. I think we got everything. Yep, that's everything.
Yeah, that's it.
All right. Well, thank you, Gwen.
Thank you.
You're so
And
you're so-
James, and James,
And James in the
your tech
background.
man in the background.
Okay.
We love you all and appreciate you all. And wait a minute, somebody said in the comments, they said, "Is it cheaper to be single?" Who said that? Reverend Carter asked, "Is it cheaper to be single?"
Oh.
I'll let you answer that question.
Well, you know what? It appears so. It appears so.
Well, there's more in value to being married than just money.
Mm-hmm.
That's for the married couples. That's the other ministry, guys. Married couple ministry. We talk about that.
I should have said it is as opposed to being head of household.
Right, because see, head of household, yeah.
Okay, thanks.
Thought you asked for a reason, Reverend Carter.
But you can't be head of household unless you have a dependent. So that's what everybody's the head of their household, but some people misunderstand that. We all heads of our household, but you got to have a dependent to be head of household.
Okay.
Okay.
Shelley White
Thank
said,
you.
"Really appreciate this presentation, Shelley." Matilda Watson hit hand clap.
Okay.
Kimberly said, "Thank you." Anna Bradley said, "Great program. Thanks," with a hand clap. Gloria Allen said, "Very informative. Thank you." So yes,
Well,
thank you,
all of
Gwen.
you who came out. No problem. I thank everyone who came out and learned a little something. Wish we had longer. But there's so much to the tax law. You would never be able to cover it all. There's so much. But hopefully you have the right preparer. Especially those of you who are that military. If you get military retired pay, you make sure you're prepared. Knows to reduce your income. Okay.
That's right.
All right, there's some more chats coming in. See, Patricia Brown said, "What is your tax fee?"
What's my what?
Tax fee.
Tax fee.
Oh, Patricia Brown gonna have to contact me.
Oh, okay.
That there is no flat rate. It's based on what I do for you. It's no flat rate.
Okay.
And then Tara Cheatham said, "Thank you for this information." Cole Martin said, "Great program, Miss Gwen." She did a big heart with hand claps. I think that's everything.
Okay.
All right, so our next meeting, Personal Finance Ministry, will send out the information. Esther Hines said, "Thank you. I need more tax information. I will reach out."
Okay.
Our next meeting will be, this was February's meeting, and for March, we're going back to Tiffany Olice's book, Get Good with Money. We're studying the chapter Retirement and Wealth. And so the March meeting will be the first Saturday in March. That's next Saturday, March 2nd at 1 p.m. So we'll do the audible book. We've gone through 6 chapters. This is chapter 7. We did the first part of chapter 7 last month. So we're going to be learning about retirement and how to build your wealth. Yeah, the month before last. So we'll give you out information on that. Also, we're going to send out information. The Personal Finance Ministry is going to be inviting everybody to our church's Bible study. Bible study meets every Wednesday. And Reverend Boyd has been working on programming, and he's wrapping that up. And in several weeks, he's going to be picking up a new book that we'll be studying. I know we're studying a book already, but for those of you who want to hear from our pastor on finances, and Reverend Boyd, I know you're on, correct me if I'm wrong, but the book is God's Money, Managing God's Money by Randy Alcorn.
Alcorn, that's correct. Managing God's Money by Randy Alcorn.
He has a great first name. So
yeah, it is.
So did you want to speak on that? And Reverend Boyd, did you want to speak on anything?
No, I think you said it. I'm hoping, excuse me just a minute. My allergies, let me clear my throat. I'm hoping that we will be ready to start within 2 weeks. It's been difficult for some people to get the books in that Sister Hall had ordered, and I think they just arrived. At least she said they were coming in. I think Friday, yesterday, and I didn't ask if they showed up or not, but you know, because I'm ready to get started. I'm just waiting for those to get the books so that they can and give them the opportunity to at least read the first, you know, couple of chapters. They're very small chapters. It's not each chapter is a small chapter, but so as soon as I know that those books are in, and I would say within 2 weeks we should get started.
Also, Reverend Boyd, we got our copy on Audible books. So if those of you who are familiar with Audible, you can download your copy and get started and be ready to go right away. It takes all of.
Yeah, that's great. Yeah, you can definitely do that.
So again, the name of the book is Managing God's Money by Randy Alcorn, and we'll send out information to the Personal Finance Ministry recipients on how to log on.
Okay.
To participate on Wednesdays at 6 o'clock, and we should be getting going in a couple of weeks.
Okay, in a couple of weeks.
So Veronica has it up, but we can't see. It's blurry, Veronica.
Okay.
All right. All right. All minds clear. Reverend Boyd, do you mind sending us out in prayer?
No. Let us pray. Eternal God and Heavenly Father, in the matchless name of your Son, Jesus, I call on you again this day. Father, thank you for allowing us to gather in this information session that has been beneficial to your children. We thank you for Sister Carney. Thank you for the finance ministry team giving us an opportunity to witness this information. Father, I ask now that you keep your loving arms around each and every one of us as we depart from this Zoom, but you do not depart from us, oh God. So this we ask in the matchless name of Jesus, and say amen.
Amen. Amen.
Amen.
Thank you, everyone, for coming.
Yes.
Thank you. Thank you.
And Gwen,
Thank you.
don't forget.
Great program.
What'd you say?
No, I was like, Zelda just said we got it, so we good.
Send the host back to us. Yeah, we got it.
Okay. So, oh, you did get it back?
Yes.
Okay, so I'm good.
You're good.
You're good.
Thank you.
I didn't want to mess up
Everybody,
anything.
see y'all soon.
All right.
Okay, we'll see you
Next
soon.
week.
All
Drive
right,
carefully,
bye.
Not
Carla.
next week, but soon.
Oh, not next week, but soon.
I said not next week.
Do you, Berg?
Bye, Joanne.
All right.